Hello everyone, welcome to the Badger Loans vlog. This time we're going to continue in the lending basics and sort of doing a series of short videos just explaining some of the stuff like what subject to status that most people know if you've been on the planet for over 20 odd years, but a lot of people don't know, and why would you if no one's explained it to you? So we've covered ping trees, we've done what subject to status, and this time I'm going to do a little quick video on APRs, because every advert you ever see on the TV for short-term high-cost loans or payday loans comes with an APR in excess of 1,000%. And everyone thinks, oh, they're so expensive, they're this, and they are expensive, but the interest rate isn't 1,000%. We had a home credit license back in the day, about 5 years ago, and really didn't like that way of doing business. But to give you an example of an APR, well, here, if I ask you the question, we did an APR of 33,000%. So it was on a £100 loan. How much was added on top? How much do you think we'd have had to add on top to get an APR figure of 33,000% to a £100 loan? It was 60 quid. And it was only 60 quid because it was her first loan and wanted to be sure that she'd pay it back. Straight as soon as she paid it back, she got one for a lot less than the £60. And £60 as an interest rate is a lot of money. But of course, what people don't realise with the home credit market is you're having to go out and collect the money. That's where all the cost is. And until your round is a large round, you've got petrol expenses, your time, the whole day will be taken up with going out and collecting it. And then, of course, there's all the people that don't pay. So that all gets factored into their APR. And as we've seen, even Provident has stopped doing it. And perhaps we'll do a little video on Provident because I work for them. So there is a blog post on Provident. So APRs, what are they? Annual percentage rates. They were brought out in the 1990s, if memory serves me correctly, because that's when I was mortgage broking. So APR was brought out because at the time, base interest rates for mortgages were somewhere around 14–15%. And all the high street lenders, and just the lenders in general in the mortgage market, were telling customers, we've got a rate of 2.99% for 6 months, or 5% for 3 years, something like that. And what they weren't saying is that at the end of those 6 months, you're going up to 15%. Oh, and by the way, we're putting all these fees on them as well. So, people were getting ripped off. So huge outcry. So the annual percentage rate was brought in order to reflect the true cost of borrowing over the course of 1 year. And that's the important part, because it's over the course of a year. And you cannot compare apples with oranges. It's got to be like for like, and short-term loans are short-term loans, and typically they're less than a year. So here's how you get the APR. You have to take the customer has paid let's take the example of that £100 loan that was 33,000%. I think it was for 8 weeks, something like that. So I put 60 quid on it, so it was 160 quid. So to get to the APR, say she was paying 20–30 quid a week, something like that, you had to take her payment, and then you go up to the 10–12 weeks that her contracted loan was for, and then you have to assume that even though she's paid off the loan, she continues to pay for another year, for the rest of the year, rather. It sounds as complicated as hell, and it is, but that's how you get to it. For a short-term loan, it doesn't work. That's why all of those loans look like they are prohibitively expensive, whereas in fact the actual interest rate that you're probably paying on most payday loans is about 50%, 40–50%, and that's still a lot of money. But don't forget, your credit card, is probably 30%. If you've got a Vanquish card, it will be 35%. My Nationwide card's 15%. So, they're not cheap either. But payday loan, of course, you're paying for the convenience of someone lending you money for a very short period of time and trying to get it all back. And I can tell you now, payday lenders do not make any money on their first loans, which is why they were also keen to roll people over and start offering them more money halfway through the loan so that they've got them for the second loan, because that's the one they'll make a profit on. They don't make money out of loan number one at all. So there we are, annual percentage rates, like comparing horses with bananas. Doesn't work. But that's what the FCA say we have to do, so we have to put the APRs on there. And the only thing you can say is if it's 1,000%, it's an expensive loan, and they are expensive loans. But that's it. They're designed to measure loans over the course of a year. And for us in the short-term industry, we're doing loans typically from 1 month to 12 months. So on a 6-month loan, you have to pretend that the customers paid their loan off after 6 months, and then even though they paid their loan off, they continue to pay for the next 6 months until the year is up, and that's how you get to the APR. That's it in a nutshell. We'll be back with some more soon. Thanks for watching. Goodbye.